July 10th, 2026. That day, Wall Street is about to receive an uninvited guest. South Korean memory chip giant SK Hynix is crashing the US market directly via an ADR. You might think, so what? Just another foreign company listing, nothing to get worked up about. But here's the thing, that day could be the very first frame where the AI bubble shifts from full-blown frenzy to micro-level cracks. Micron Technology, a $1.29 trillion memory chip giant, its troubles are just beginning. On July 10th, SK Hynix will officially start trading in the US via a Nasdaq ADR, planning to raise up to 45.45 trillion Korean won, that's $29.4 billion. One of the largest semiconductor listings in the US in recent years. Who is SK Hynix? One of the world's biggest memory semiconductor companies specializing in DRAM, NAND flash, and the stuff the AI industry is most starving for, HBM, or high bandwidth memory. HBM is that super memory that Nvidia's GPUs absolutely need to run large AI models. Before this, if US investors wanted to buy SK Hynix, they had to go to the Korean exchange. But after July 10th, Wall Street can buy a direct competitor to Micron with just one click. What does that mean? It means Micron has just lost its only major memory stock in the US, scarcity premium. Hold your horses. Don't write off Micron just yet. Let's look at the cards it's holding. Micron's recent performance? Explosive doesn't even cut it. Sales and profits are growing at breakneck speed. Demand is red hot, supply is tight, textbook environment for price hikes. Philips Securities just raised its fiscal 2027 revenue and profit forecasts for Micron. Why? Because Micron has locked in 16 long-term customer supply agreements worth roughly $100 billion. Buyers are so desperate to secure supply that they're rushing to sign long-term contracts with Micron. Over the past year, memory chip prices have surged while new capacity remains limited. Micron's stock has climbed sharply in 2026, hitting a market cap of $1.29 trillion. Sounds perfect, right? But here's the rub. All these positives are already fully priced in by the market. We've talked before about the 6 conditions for an AI bubble burst. Number 5 is, market no longer awards good results from the leaders. That's the classic late-stage bubble signal. Look at what's been written about Micron lately. Sales growth, profit surge, pricing power, billion-dollar deals. Not a single piece of bad news. This is what they call buy the rumor, sell the news. The market's pricing logic has shifted. It used to ask, is growth still there? Now it asks, is growth enough to justify this price? Micron's $1.29 trillion market cap has already swallowed every bit of good news. At this point, even if earnings remain stellar, unless it's a blowout beat, the market will say underwhelming. SK Hynix's July 10th listing puts 3 layers of pressure on Micron, and they stack up. First, valuation comparison pressure. Before this, Wall Street could only compare Micron indirectly with Samsung and SK Hynix via their Korean stock prices. Messy. Now, SK Hynix is trading on Nasdaq, and financial metrics can be laid side by side. PE, PB, gross margin, HBM market share, all clear as day. Second, capital diversion pressure. After SK Hynix lists, ETFs and index funds that track MSCI, NASDAQ, or AI themes will passively or actively rebalance, selling Micron and buying SK Hynix. This isn't new money, it's existing money shifting homes. Micron and SK Hynix are in the same niche, direct substitutes. If you buy SK Hynix, you're likely to sell Micron. This isn't speculation. Wall Street will have to answer the question, will capital rotate to SK Hynix or stick with Micron? Third, gross margin pressure. If SK Hynix expands capacity and adopts more aggressive pricing, a drop in HBM pricing will directly squeeze Micron's most profitable business line. Micron's fattest profits come from HBM, and that's exactly SK Hynix's home turf. Some might say, isn't lower HBM pricing good for Nvidia? It reduces their procurement costs. Short term, yes, lower HBM prices mean lower costs for AI chipmakers like Nvidia, which helps AI hardware gross margins. But long term, if a price war turns into sector-wide overcapacity, it will trigger the very first condition for an AI bubble burst, a downward revision in CapEx expectations. Bloomberg knows that HBM supply shortages are expected to last for years, meaning there's little room for a price war in the short term. But here's the but. If the expansion plans of SK Hynix, Samsung, and Micron all materialize on schedule, the supply gap could shrink rapidly over the next few quarters. When that happens, the real pressure from price competition will emerge. And once a price war kicks off, It won't just be Micron that gets hurt. Semiconductor equipment, optical modules, data centers, the entire AI hardware chain, all of it will be dragged down. We've previously identified the sixth condition for an AI bubble burst: passive ETFs and quant funds reversing in sync. AI memory chips are heavyweights in Nasdaq and various AI theme ETFs. After SK Hynix's ADR listing, index funds and ETFs will passively or actively rebalance, selling Micron, buying SK Hynix. The contagion chain goes like this: AI leaders fall, indices retreat, ETFs sell passively, quant models reduce risk exposure, option market makers hedge by selling, leverage funds are forced to cut positions, leaders keep falling, and then non-leaders and high beta assets plunge in sympathy. That's why crowded trades fear simultaneous reversals the most. And July 10th, with SK Hynix's listing, is precisely the physical trigger that could unlock the congestion in memory chip holdings. So, back to our opening question, what happens on July 10th? A needle will prick the AI memory subsector. If that needle causes Micron to tumble and drags down the Philadelphia Semiconductor Index, then this leader catchdown could easily spread to the entire AI hardware chain. Nvidia, AMD, Broadcom, none will be spared. Micron's fundamentals aren't bad, but its ownership structure is turning ugly. The $1.29 trillion market cap, the $100 billion in long-term contracts, the 16 supply agreements. All these are yesterday's good news, and the market always trades on tomorrow's expectations. When everyone is crammed into the same narrow corridor, all it takes is one person shouting "make way," and the stampede begins. Cut through the noise and see the real picture. If you're vibing with this content, smash that like button and subscribe. See you in the next one.